In commercial real estate, everyone thinks they own their buildings. But here's the truth most won't say out loud. If you're levered at 75%, you don't own 75% of the risk. You own it all. Because when the math stops working, the lender doesn't lose sleep. You do. Right now in Richmond, Virginia, there are investors sitting on multifamily assets they bought in 2021 at 4.2 cap rates. Properties that pencil beautifully when bridge debt costs 3.5%. Full occupancy, strong rent growth, clean exits plan for 2024. But it's 2025 now, and those loans are maturing. The bank's offering 7% to refinance, maybe 7.5% if your coverage ratio is tight. Ownership is an illusion. Control is the only asset that matters. Because here's what no one tells you when you sign the loan docs. Leverage isn't patient. It doesn't care about your thesis, your track record, or your long-term hold strategy. It cares about one thing, the timer. And right now across Richmond's multifamily market, that timer is about to go off. So let me show you how this works. Say I'm an investor in 2021. I buy a 200-unit Class A property in western Henrico County for $4 million. I put in $10 million of my own cash, 25% down. And I borrow the other $30 million from a lender at 3.5% interest. So $10 million in my own equity, my risk. $30 million is in debt, the lender's risk. But here's the thing, the debt isn't really their risk because they signed a guarantee, or my fund did. Either way, if this deal goes sideways, the debt is my problem. Now, in 2021, that 3.5% interest rate meant I was paying about $1.05 million a year in debt service. The property was generating $3.2 million NOI, the net operating income. So my debt service coverage ratio, my DSCR, was around 1.36x. Comfortable, conservative even. But then something happened. The Fed raised rates, not a little, a lot, from near zero to over 5% in less than 2 years. And suddenly my bridge loan, which was supposed to be temporary, came due. So I went back to the lender to refinance. But now instead of 3.5, they're quoting me 7. $30 million loans now cost me $2.1 million a year. My DSCR just dropped to 1.15x, and if cap rates expanded even slightly or a few tenants left, I'm underwater. So here's what most people don't understand. Leverage doesn't care about your strategy, it cares about your timing. And right now in Richmond, timing is everything. Now you might be thinking, okay, so some investors overpaid in 2021. That's not new. Market's correct, that's what they do. But here's what makes this different. It's not just one investor. It's not just even one asset class. According to the data, nearly $1.5 trillion in commercial real estate loans are maturing between 2024 and 2026 nationwide. That's office buildings in downtown Richmond. That's retail centers in Chesterfield County. That's multifamily complexes in western Henrico that were bought at peak pricing, bridge debt. And here's the pressure point. Most of those loans were originated between 2019 and 2022 when rates were at historic lows and cap rates were compressed. So let me paint the picture. You've got an investor who bought a Class A complex in Short Pump in 21 for $50 million. Cap rate, 4.2%. Loan, $37.5 million at 3.25%. Floating rate, 3-year term. Occupancy was 96%, cash flow was strong, everyone felt good. But now it's 2025, that loan matured, the lender wants 7.5% to refinance, or they want out. And the investor has 3 options. 1, pay down the loan with fresh equity, but where's that coming from? LPs are tapped out, they've already been hit with capital calls and other deals that didn't perform. 2, sell the asset, but buyers are scarce, and they're underwriting at 6% cap rate now, not 4.2. So the asset's worth $35 million, not $50 million. You're facing a $15 million loss. Or 3, default. Hand the keys back, walk away, let the lender deal with it. And that's not doomsday scenario. That's a Tuesday in 2025. Because when debt costs more than the asset can support, you don't have a real estate problem, you have a math problem. And math doesn't negotiate. In Richmond specifically, vacancy rates peaked at 9.7% in the late 2023, and 3,300 units were delivered in a single year. Asking rent growth, 0.4% over the past 12 months. Meanwhile, operating expenses per square foot are up, insurance is up, taxes are up, and the gap between what properties were underwritten to generate and what they're actually generating, that's where the pressure lives. So here's the part no one talks about. Markets don't punish ignorance, they punish ego. Because every investor who's facing a maturity wall right now thought the same thing. I'll refinance when the time comes, rates will come back down, the Fed will pivot, but the Fed didn't pivot in time. And even if they do now, the damage is already done. Because here's what leverage really is. It's not a tool, it's a timer. And the timer started the day you signed the loan docs. Let me give you an analogy. In any craft, wine, architecture, real estate, there's a concept of terroir. The soil, the climate, the conditions that make something what it is. You can't fake it. You either have the right conditions or you don't. Commercial real estate works the same way. The terroir of a deal isn't the asset, it's the capital structure, the debt, the equity, the timing. And if your structure was built for a 3% world, it doesn't survive in a 7% world, no matter how good the property is. I've been in this business long enough to know great investors don't chase returns, they chase rhythm. The rhythm between chaos and calm, between expansion and contraction. And right now, we're in contraction. So the investors who structured for permanence, who underwrote conservatively, who stress tested at least 6 or 7%, they're fine. They're bored maybe, but they're fine. The ones who structured for growth, who levered up, who assume rates would stay low, who bet on appreciation instead of cash flow, they're learning humility. And humility is expensive in commercial real estate. Because here's the truth, every cycle, same story, people think they're buying property. But what they're really buying, stories. Stories about where the market's going, stories about what the Fed will do, stories about their own intelligence. But great investors, real investors, don't buy stories. They read the narrative beneath the numbers, and right now the narrative is simple. Debt is revealing who built for the long game and who was just playing pretend. In Richmond, absorption has been strong, 3,200 units absorbed over the past year, but deliveries match that almost exactly, which means vacancy isn't improving fast enough to save over leveraged deals. The market's not broken, it's just patient, and patience is something debt doesn't have. So what happens next? Some call this a correction, others call it a cleansing, but for investors who mistime their debt, it's just gravity. In Richmond, multifamily transaction volume is down nearly 40% year over year through Q3 2025. Not because there aren't buyers, not because there aren't deals that make sense. Sellers are still holding on to 2021 pricing. Buyers are underwriting the 2025 reality. And the gap between those two numbers, that's called now. But here's where it gets messy, because it's not just individual investors taking a hit, it's the entire ecosystem. Lenders who extended bridge loans are now sitting on non-performing assets. Servicers are managing more workouts they've seen since 2010. And borrowers, especially smaller funds, family offices, syndicators, are realizing they don't have the liquidity to survive the waiting game. I've seen it in Short Pump, I've seen it in downtown Richmond, I've been in Midlothian, properties that were bought at peak pricing, levered to 75 or 80% LTV. Now the sponsor's scrambling to raise another $3 million just to stay alive. And while assets trade down, reputations trade faster. Because in this business, value doesn't vanish, it transfers from the impatient to the prepared, from the speculative to the strategic. And here's the part that stings. Most of these investors weren't reckless. They weren't idiots, they just mistimed the cycle. They thought 2021 was the middle of the expansion. Turns out it was the top. And the difference between the middle and the top, 6 months, sometimes less. But that 6 months, that timing, is the difference between a 25% IRR and handing the keys back to the lender. It's a difference between raising your next fund and shutting down your firm. It's a difference between being remembered as disciplined or being forgotten as desperate. So when people ask me who's going to lose their leverage, I don't say the bad investors, I say the ones who thought leverage was optional. Because leverage isn't optional, it's binary. You either control it or it controls you. And in 2025 in Richmond, it's controlling a lot of people. So what do we do now? Hold what's real. Let everything else breathe. Because here's what I've learned after 2 decades in this business. The game was never about buildings, it was about time. Who controls it, who respects it, and who wastes it. The investors who survive this cycle won't be the smartest, they won't be the most aggressive. They'll be the ones who structured for patience, who underwrote for 7%, even when the market was pricing at 4%, who said no to deals that only worked if everything went right. Because in commercial real estate, conviction isn't loud, it's quiet. It's in the deals you don't do, it's in the capital you don't deploy, it's in the leverage you don't take. But when the next cycle comes in, and it will, money will chase returns again. Everyone will feel untouchable again. Cap rates will compress, debt will be cheap, deals will pencil, but the whys won't chase returns, they'll chase rhythm. The timing between chaos and calm. Because when that happens, you'll know who played the long game. You'll know who built for permanence, and you'll know who got lucky with timing. Leverage isn't a tool, it's a timer.